The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is the senior Chanticleer columnist at the AFR, Tony Boyd. Hello, Tony. How are you?
Very good, James. And actually, last Saturday night at a party, I ran into one of our listeners.
Fantastic.
And he was really enthusiastic. So I think we might actually be doing a good job.
Oh, don't say it out too loud. It's good to meet one of the listeners, though.
Yeah.
And he's going to love today's show, too, because we've got an action-packed show. This week, we're going to look at the fall of a controversial bank CEO. We're going to examine the ups and downs of China's COVID crisis, and we'll look forward to the Reserve Bank's final interest rate call of the year. Will they or won't they? But while we wait the latest news on Australian rates, hope that the pace of US interest rates might have peaked put a rocket under equity markets around the world in recent days, and none more so than the famous old Dow Jones Industrial Average, the big benchmark of Wall Street. And amazingly, it's up more than 20% since the middle of October, and a 20% rise is traditionally seen as meeting the definition of a bull market. Tony, how did we get here? We're back in a bull market.
Well, this is looking like a really good Santa Claus rally, and I think there's a few reasons for it, James. One is the potential of China abandoning its zero COVID policy, and also a speech given this week by Jay Powell, who, as usual, was quite sort of enigmatic, and people interpret it in two ways. And, of course, the equity market interpreted as the inflation is peaking and that the US Fed will actually have done enough by early next year. So that's good for share prices.
Yeah, well, Powell he didn't really say anything too different. He said again that they might look to slow the pace of rate rises in December. I think they make their interest rate call on December 12 or 13 around that time. So we knew that was going to happen. And then again he said, but hold your horses, inflation's too high and we might have to hold rates higher for a lot longer than the market thinks. But whoosh, equity markets just heard what they wanted to hear, which was slower pace of rates, and off they went. Tony, how's this going to set up 2023? You had a chat to Macquarie this week about what they think are the best assets to invest in. What are they thinking about rates and where investors should look?
Well, I spoke to their head of fixed income, Brett Luthwaite, and he basically said that he thinks the terminal rate from the Federal Reserve will be 5.35%, which I think is down the lower end of the range. He was quite positive about fixed income, naturally, as an investment, and he's been managing a $3.5 billion fund there for about 20 years. But the annual outlook for 2020, well, for this year coming from Macquarie basically opts for three things. It says investors need to get into infrastructure, agriculture and fixed income. They're a bit more cautious about shares, and that's because they just think that the rising interest rates are going to hold back people going into that. But what's you've been writing, I think, 3 columns this week about the markets. What's your feeling at the moment?
Yeah, I think most people seem to be seeing a year of two halves in 2023. The first half's going to be pretty rough as a sort of recession in the US starts to bite. And then in the second half of the year, when central banks sort of feel the pain of that recession and maybe start to look towards rate cuts, most people could see a sort of bull market for equities. I was interested, though, in the Bank of America's chief strategist in the US, Michael Hartnett, who's I've been following all year. He's very bearish, but he writes in this really colourful way. He actually, interestingly for a US strategist, had an Australian angle. He said to go short the Australian banks because he reckons the real estate market in Australia was so overheated and it will continue to unwind. I'm not so sure about that, Tony. Australian investors love their bank stocks. They love the dividends they provide, and shorting the banks has usually been a pretty bad trade, hasn't it?
It has. I remember The Economist magazine, this is going for potentially, I think, probably 25 years. They said Australia had a housing bubble, but of course they never really factored in negative gearing, which is one of the things that actually drives people's investment in real estate in Australia. So maybe Hartnett's fallen into that trap of being a foreigner, not understanding the market and predicting a doom and gloom when it probably won't happen at all.
Okay, well, Tony, we'll look at another bank story now, and as our first big yarn of the week, and that was the controversial removal of Bank of Queensland's chief executive George Frazis from his post just 6 weeks after he delivered the company's full-year results. Now, Tony, you've really been all across this story. George is a controversial, colourful figure. Tell us a little bit about his management style and why it grabs so much attention.
Well, in March this year, I wrote a column, James, about his unique style, and it included reference to the fact that, he loved off-site events at pretty swish places in Byron Bay, Kingscliff, the Blue Mountains. Loved taking his top 100 executives out there. There was a lot of talk that he had his own special wine and he only drank Fiji water. I mean, there was all sorts of unusual stuff, like he told his EA that he didn't want any appointments in his diary before 11 a.m, but then he'd be sending messages to staff at 1 o'clock in the morning. So, I mean, there's no question the guy worked very hard, but a lot of his communication with staff was through WhatsApp. He doesn't use a laptop. He used an iPad and a mobile phone. So there was some, unusual stuff, and including, and I didn't want to get too much into this, but they were moving to new headquarters in George Street in Sydney, and the story was that he'd asked to have his own sort of private bathroom. Now, when I told the chairman that, he said, "Oh no, that's not going to happen now." But there were things that I told the chairman, Patrick Alloway, who used to be a director of Nine, by the way, were a shock to him. I told him that George didn't go to the monthly Asset Liability Committee meetings. Now, these are the meetings that are the core of every bank, because they tell you, how your loan book's going against your deposits. And so, yeah, there was a lot of stuff there that really sort of came as a surprise to the market and caused a lot of unease among investors. And nothing more was sort of heard of it till about 3 months ago. I heard that Patrick Alloway himself might step in as CEO and that George was leaving. But Patrick denied that to me. So lo and behold, last Sunday, George was gone. I mean, did you find it a bit of a shock to happen on a weekend like that?
Well, not only was George gone, but as you predicted, Tony, Patrick Alloway is now the executive chairman and is running the joint while they look for a new CEO. I mean, I think this was sort of one of those unsurprising shocks, if you know what I mean. It is a shock when any chief executive of a listed company is removed effective immediately. And so, we've both spent the week trying to find out, was there a sort of incident, a straw that broke the camel's back, so to speak? My sense, Tony, from the people I spoke to was that wasn't the case, that this was a sort of build-up and a clash of styles and partly a change in strategic direction. Is that your reading of the situation too?
Yes, well, I think Patrick Alloway said that they needed a different sort of leadership to go forward. But there's some interesting things happening. Bank of Queensland was going hell for leather on mortgage loan growth till about July, when it just stopped dead in the water, and now all of it's negative towards mortgages compared to the system growth, and it seems to be conserving capital, although they say there's no capital problem at the bank. So, yeah, look, I think Patrick will have a huge challenge finding someone to replace George, because there's so many issues, not just regional banks being, strained to compete with the Big Four, but there's a big technology transformation project. It's worth $440 million and will take three to 4 years. So there's a lot going on there. I mean,
yeah. There's also, Tony, the little matter of integrating this acquisition that George was sort of George's signature move, the $1.3 billion acquisition of ME Bank. That deal is 1 year into the integration. We're told the integration's going well, but that's another issue for BOQ to digest that business and get ME Bank and BOQ together running as well as they want. That's not easy, is it?
Well, no. I mean, the best measure of efficiency of a bank is the cost-to-income ratio, which in Australia is somewhere between 45 and 50. So in other words, it costs you about 50 cents to earn every dollar. Now, the trouble with ME Bank, its cost-to-income ratio is about 70. So it's 70 cents to earn every dollar, and it didn't have any branches. I mean, where's all that? No wonder the industry super fund sold it. So, look, it's a tricky one. these big acquisitions are often the landmark that every CEO wants to sort of pin their name on, but I'm afraid this will land in the lap of whoever replaces George at Bank of Queensland.
Mm. And the big question, any sense of who that person might be?
Well, I did a bit of a ring around, and from what I'm understanding, that the three, there's some very talented women in banking in Australia who the headhunters are bound to call them up. And Antonia Watson at ANZ in New Zealand, yep. Angela Mentis at National Australia Bank, and I think it'd be great if banks have a history of bringing in people to solve a crisis, and I think this is potentially could be put into that category. And unfortunately, whether it's unfortunate or not, often women are called in to fix the problems created by men. So maybe this will be another example of that. Yeah,
and how long do you think Patrick Allaway is in the hot seat for? I mean, this doesn't feel to me like he's going to be able to find a new CEO quickly from what you're saying.
No, look, he's given himself 9 months, and who knows, maybe he'll do a Gonski and David Gonski searched for someone to run the Future Fund and then took it over himself as chairman there. Maybe we'll find Allaway becomes the CEO in the end. I don't know. It's happened before.
Fantastic. It's one to watch, and well done for your work on this story. You've really made the running on it. Let's move to our second big story of the week. This has been an absolute roller coaster. China's COVID situation has been a problem for about 3 years really now, and we started the week with that problem bubbling over to the surface with protests against lockdowns spreading across several Chinese cities, and what looked like real mounting opposition to President Xi Jinping building up in the streets of China. But as the week wore on, the protests rapidly faded, and we've got now a sense that China will start to ease those lockdowns and try to get its economy open and firing again. Tony, I've been following this a bit, and it looks like to me that China's got a really tough choice. That they've either they continue the lockdowns and they continue them quite strictly. That'll help keep cases and death rates down, or they open up, and because their vaccine coverage is so poor and their vaccines are so poor, they risk seeing case numbers explode and deaths explode in what is an ageing population. Neither option's too great for the economy, is it?
No, not very good at all. I mean, in a sense, they're facing the type of choices that Australia faced in 2020 when we didn't have a large proportion of the population vaccinated and had to be, confined to our homes. Yes. And that continued through into 2021. But as the vaccination rates got up, and we're now at a level where Australia is, got COVID happening in the community, but people are either working from home or coming to the office or being more careful. But China can't do that, especially people aged over 80, very low levels of vaccination. And then, of course, there's questions about the efficacy of the Sinovac vaccine, which has, is not as good as the mRNA vaccines that have been used all around the rest of the world. So he sort of created a problem for China by not getting the vaccination rates up very highly while people have been in lockdown for 3 years. So that's come back to bite to Xi Jinping.
Which is bizarre, isn't it, Tony? I mean, they seem to have put so many resources, so much time and effort into keeping people locked in their houses rather than putting the effort or dividing the effort between lockdowns and a mass vaccination program. I mean, this is where a sort of command and control economy should work really well. Everybody get vaccinated, do it now, and you would have thought they'd be further down the track. It baffles me that hasn't happened.
Well, we had our protests in Australia, you remember, James. There were some in Melbourne, some in Victoria, and they're happening in China. And, of course, it usually starts with a single incident that then blows up. And in their case, it was an apartment block fire in a far western city of Urumqi. I'm probably not pronouncing that correctly, but 10 people died. And then it was suddenly all over social media, in particular their biggest network, WeChat. And that's then led to protests in Shanghai, Beijing, Wuhan. A dozen cities have had protests. So I think that was the reason why you noticed this last week. There's a definite change in the language and mood coming from the Chinese officials.
Yeah. This really matters to Australia too. I mean, we've seen what's happened to the iron ore price this week as a good sort of guide to how things are moving. Iron ore got down to sort of towards $80 US a ton. It's now back up to $100 US a ton on the hope that China's economy will reopen, and that will mean lots more activity and building and infrastructure and all that sort of stuff. So what happens in China? Australia needs China to get this right, don't we?
We certainly do. I mean, when you think about iron ore is feeding their property sector, and the Chinese manufacturers coming the other way are filling up all those Bunnings warehouses with all those products that people love to buy on the weekend. So
exactly.
There's a sort of, it's the two-way trade that could be drastically affected if they don't open up and get this into sort of a manageable situation. Yeah,
well, the bull case now, I guess, is that China opens up early 2023. They fire up the economy with lots of stimulus. That lifts commodity prices, which lifts the shares of Australian miners like Rio Tinto and BHP and Fortescue, which in turn lifts the Australian stock market. So you can make that case. You can see that, Tony. I guess the lingering question I've got is, yeah, okay, so they have a big stimulus sugar hit, which is great, but there's still some structural issues in the Chinese economy that are a bit of a worry, aren't they?
Yeah, look, they're definitely more reliant upon construction and actually the whole, ramping up building of apartments and property, and the property sector itself has got its own indebtedness and those problems. But if they open up earlier than people expect, it could really lead to quite a sort of change in the mood in financial markets all around the world. Although there's always someone warning against whatever could happen. I saw a Goldman Sachs note on Friday saying that an earlier reopening would boost oil prices, weaken the dollar, increase the Fed's challenge to tame inflation. So yes, we might be back to where we started.
That is a good point, that this idea of a second wave of inflation. All right, Tony, question without notice. Iron ore is sitting at about $100 US a tonne right now. Wind the clock forward 12 months. China's stimulating like mad. Give us a ballpark. Where do you reckon it could be?
Oh, look, I'd probably guess about $150 to $160 a tonne, which, wouldn't be that out of the ballpark when you think it actually went up to $280 to $300 at one point.
Yeah, look,
what do you think?
You're probably right. I reckon you could get to 150 in the early part of next year as that stimulus feeds in, and then perhaps it drops more back towards that $190 a tonne. But it's one to watch because there's a lot riding on it. Obviously, not just share prices, but that those iron ore sales fill the government's coffers with tax revenue too. So very important things to watch. Tony, we're going to come back after the break and look at the most important thing to watch in the Australian economy right now, and that's interest rates. Well, welcome back. You can sign up for the Chanticleer newsletter, which comes out each Friday. It's available for subscribers, and you'll get access to the podcast and, of course, some of the best of Chanticleer columns for the week. Go to join.afr.com/Chanticleer to sign up. All right, Tony, it's a big week coming up next week. We'll take these in order of importance. Friday night actually is an important moment where we've got US jobs data. The health of the US labour market's all important at the moment. Jay Powell will be barracking for a little bit more unemployment in a strange way, won't he?
Yeah, that's right. But look, it'll probably come in where I think the consensus among economists is about 175,000 non-farm payroll employment in November, and that'd be enough to leave the unemployment rate unchanged. I don't think Jay Powell would be too unhappy with that.
Yeah, fair enough. Item 2 on the agenda is on Sunday morning at 6 a.m, of course. Not really a business story, but we'll all be cheering for the Socceroos, won't we? What an amazing story this is. What a shock that the sort of unlikely team gets out of the group at the World Cups of soccer, and we've got a date with Argentina at 6 o'clock on Sunday morning.
Yeah, isn't it fantastic? And I love the way the Prime Minister, Anthony Albanese, said probably we're going to have a public holiday if they win this tournament. Yeah, that takes me back to 1983 when Alan Bond won the America's Cup. And the Prime Minister at the time, Bob Hawke, said that anyone who sacks someone for not coming to work today is a bum. But I've consulted some experts in the office, James, and what they tell me is that Argentina's defence is getting a bit old. They're in their mid to late 30s, so they might be a bit slow, so that gives us a chance on the attacking side. Right. As for their attack, well, obviously it's one of the best in the world with Messi in there. And I'm told their right winger is the guy to watch. Now, all I know is his nickname. He's called the Noodle, and apparently he can move very quickly to the left, which is apparently one of Australia's weaknesses. So let's see what they do. If we can win this, it'll just be absolutely fantastic. Of course, with soccer, sometimes people get really excited with a 0-0 draw. I mean, that of course, is not allowed to happen because they have to have 15 minutes each way again and then penalty shootout. What's your tip?
My tip is Australia wins on penalties. It's 1-1 during the game and then we win on penalties. So it's not so much a tip as a hope. But look, I'm going to stay positive. Tony, what's your score? What's your score prediction?
I was actually going to say the same, James. I'm thinking 1-1. They get through the 15 minutes aside and then a penalty shootout, which let's hope Australia can win that one.
Love it. All right. Well, that's going to take out the weekend, and then we get up to Tuesday where we've got the big question: what does the RBA do with interest rates? Now, this is not an easy one. We're seeing some signs of weakness in the economy. Retail sales came in a little bit weaker than expected. Inflation came in a bit lower than we expected this week. Any chance that the RBA puts the pen down and says, no, we don't need to do anything in December?
Well, funny you should ask that. One of my colleagues was at a big financial institution Christmas party on Thursday night, and one of their top credit fund managers said they're going to do nothing. So that would be a really shock, wouldn't it? Personally, I think they'll go 25 basis points because they won't meet again till February, and they want to make sure they've just put one last little anti-inflation shot, into the sort of consumer sentiment, just to keep inflation under control. What do you reckon?
I think you're right. They can't hold back. They need to have a crack here, and I think you're right. 25 basis points, 0.25%, just sends a little message to the economy that, hey, we're still worried about inflation. We're being sensible about it. We'll see you in February. So I think you got that right, Tony. All right, well, we love questions from our audience, and you can email at chanticleer@afr.com with your curly question for the Chook team. And this week's is a beauty. It's from Derek, who's in the Blue Mountains, and he says, I'm currently in an industry fund which invests in unlisted assets and private equity. Is there any data that suggests these investments help outperform an index strategy like Vanguard's?
Well, I think Derek's asked a very good question here because over the last 20 years, industry funds have outperformed their rivals. When I say that, I mean in retail funds. And I thought to help his thinking, I had lunch last week with the CEO of Cbus, Justin Arter, and he was boasting to me that in the period when Cbus went into property development, integrated property development, they built apartments, they built office buildings. From 2006 to 2022, the Cbus property portfolio returned 14.9% per annum. I mean, this is quite a staggering number. And some people might even question whether, these are all unlisted valuations, of course. But then I went and called up on the Bloomberg, the REITs index in Australia over that same period. Now, that's what you would have got if you'd put your money in a Vanguard REIT index. It only returned 4.5% a year over that same period. So the difference is absolutely staggering, almost 10% per year. Another way of looking at that is that if you're earning 14.9% per year, you'll double your money in 5 years. But if you're earning 4.5% through an index fund, it'll take you 16 years to double your money.
Wow.
And, of course, I think the difference is reflected in the amount of money that our real estate investment trusts are pulling out to pay themselves, which are reducing the amount of yield you're getting, total return you're getting out of a listed entity. So whilst a passive investment in Vanguard is going to be very cheap, the way in which our industry super is set up, you'd be well behind the 8 ball over a very long period of time, Derek. So what do you reckon?
I think that's right, Tony. I mean, I think you've got to understand that the two things are different. I mean, an index strategy like Vanguard only exposes you to the listed market. So you're not getting the benefit of going into things like infrastructure, private credit, private real estate, private equity, venture capital. Now, yes, these things do come with risks, and you've got to understand those. And I think people need to engage with their super. I mean, some super funds have 50% of their assets in these unlisted, 50% of their assets in these unlisted assets, and that is a lot. There are risks associated with that. One of those risks is if there's a sudden run on a super fund where there's lots of withdrawals, it can be hard to generate the cash. If you've got lots of unlisted assets, it takes a while to sell a toll road or a port or an office building. So those circumstances are pretty unlikely, but you just want to understand that risk. And if you get comfortable with that risk, super is designed to let you do a range of things. It lets you get into different areas that you can't as a retail investor going through something like Vanguard. So I think it's a good question for Derek to ask, and it's good to engage in that issue. But, you know, there are benefits to that unlisted exposure.
Yeah, and look, it'd be good to know Derek's age, because if he's a young person, he can afford to take more risks than others. He could probably set up a pretty aggressive portfolio inside an industry super fund. And one other caveat I'd put on it would be have a look at the amount of net inflows or net outflows. If he's in a fund with net outflows, he's got to be very careful, because the cash that comes in helps a manager to hold more illiquid investments, and that's the key to the success of funds like Host Plus and Australian Super. So there's other intricacies involved, and probably the best thing to do is go to a financial advisor.
Yeah, and just to explain, Tony, net outflows means that there's more money going out of the fund to pay people's pensions or as people retire than there is coming in, and that can happen with smaller funds or funds where there's sort of a more older demographic.
Exactly.
Yeah. Well, thank you, Derek, for the question. It's a real it's one the entire economy and the super system's thinking about. So good on you for engaging in that issue and thinking about your super, because not enough people are thinking about their super. So great question. Well, Tony, thank you. It's been a great episode. Lots of ground covered, and go the Socceroos on Sunday morning.
Yes, go the green and gold.
Terrific. Thanks for listening. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow. If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you could subscribe to The Financial Review at afr.com/subscribe.
The Australian Financial Review.